All right, Angry Birds, what the hell happened to Super Mario? Quake, the landscape of media and gaming completely changing. Who better to help us understand this than Steve Eskenazi? Steve is an angel investor with deep ties to the tech industry in Silicon Valley, helped taking AOL, Lycos, Electronic Arts public, well back with Alex Brown in the 90s. Spent the better part of the last decade with Walden Ventures right here in San Francisco before striking on his own a few years back. Now, Steve, Angry Birds is this amazing thing. What's going on at Zynga? Just amazing, a very changing paradigm in gaming. When you look at this, is the biggest change taking the power away from the consoles?
Sure. I mean, that's one of the biggest ones. I think the easiest way to look at it is to imagine what we've had for the last 10 or 20 years, which was a video game industry that was dominated by a small group of publishers, a small group of platform companies like Microsoft and Sony and Nintendo, and then the retail channel.
So you had Electronic Arts and Activision, you had Sony, Nintendo,
Microsoft.
Fill in the blank, maybe Microsoft at a certain point, and that was it. They controlled everything.
They pretty much. I mean, that was the lion's share. I mean, 80+% in an 80-20 world. They were 80+% of everything: platforms, retail sales, and then publisher revenue as well.
So Angry Birds changes that because now the power is where?
Well, the power has shifted. Obviously, we have new platforms in the tablet and the handheld, and additional potential partners or competitors with the cellular carriers. So Angry Birds, which has been this amazing phenomenon, I think in December they announced that they had 50 million downloads, and then at South by Southwest last week they said 100 million, so you figure it's about 1 million every couple of days.
Amazing.
Now the power sort of shifts in their conversations to, one, become a platform, and then two, to control the economics around how it's going to be distributed and how it's going to be monetized.
Steve, the Rovio chairman recently told a Finnish magazine they're aiming to be as big or bigger than Google or Facebook. Is that possible?
Well, you never want to underestimate how quickly these businesses and revenue streams can take off. It's an ambitious goal, and as an angel investor, you like those bodacious kinds of pronouncements. Look at, for example, Groupon. If somebody were to tell you 18 months ago Groupon would have done $1 billion last year, people would have pretty much laughed. So they have a lot of different, Emily. They have a lot of different avenues to go with this, and they can take it more in a Hollywood direction. They can take it more in a platform direction and a licensing direction. So I wouldn't quite rule it out by hand, but it's certainly an aggressive goal.
Angry Birds obviously wildly popular. Zynga growing by leaps and bounds. Do you see social and mobile gaming outgrowing their predecessors' traditional gaming?
Absolutely. I think people have now, and one of the reasons why angel investing has taken off, and you see some of the valuations the way they are, is because people have realized the power of social media. And, gaming is one piece of it, and Zynga led the way in breaking the stranglehold that, what we talked about before, the small handful of publishers and retailers and platform makers had. So yes.
So what does that mean? I mean, so what? So the power goes from one guy to the other. What does it fundamentally mean when a Zynga and an Angry Birds or Rovio controls the power in the relationship with the consumer?
Well, it means the economics change. It means that what used to be, again, go back to the older video game business, where $10 million a title was nothing, and it was Hollywood type budgets.
Right.
Now these businesses are much more capital efficient, which tend to scale much faster. It's also not aimed at the classic 15 to 35-year-old guys without a date on Saturday night. It's much more broadly, broadly liked by, kids. My kids love it. Yeah, it's broadened into the older
and
demographic.
Old dads like you,
old
at least
dads
like me,
like you and me.
Hold the thought. We're going to get back to this in just a second. Now, I know we're going to get to some more bubble talk, because I know you insist it isn't a bubble. Others, Facebook topping $80 billion in valuation. And I also want to talk about why you think Mark Cuban has lost his noggin. We're going to get to that right after the break. Facebook, crazy IPO valuation, pre-IPO valuation, I should say, importantly. Maybe 80 billion, sometimes 50 billion. We talked to two guests yesterday, Paul Kudrowski, chief among them, who was saying, perhaps the last private round might be the highest round, and the IPO is a down round. Why don't you think we're in a bubble?
Well, I think it's important to define what a bubble is. I think when people say, is this another bubble, they look back at the year 2000 and what happened there. Yeah. So if we look at those companies, first, you had an investment banking infrastructure with, the Alex Browns, the Robertson Stevens, and Montgomery Securities and H&Qs that were...
All four companies no longer here because they're based here, but they're no longer in existence.
Exactly. I mean, they were an absolute, machine of IPOs. They were doing multiple IPOs per day. Yeah. We certainly don't have that anymore. Second, the money that was raised by these companies was raised to meet payroll. Third, they had single markets.
Well, another way to back up. So the companies that were getting IPO funding didn't have any functioning business model whatsoever. They just needed IPO money to keep the cash register even on, if not ringing.
And to keep the hope alive, right? Because they had predicated the business on, a bunch of assumptions that if they all came to be, would have led to a business. But again, your, dependent probabilities all multiplied together are not very likely. In addition, that the first IPOs in the 2000 timeframe weren't the high quality people. It was the Globe, for example. Right now, let's contrast that to what we have today. And I think the top three reasons I believe that we're not in a bubble, as I just defined it, is one, I call it the better, larger, faster attributes of this group of private companies. Much better managements. You had Gurbash Shahal and the Radium One people here last week. Right. That was a business that's only 18 months old, already profitable.
Which people could see on our page on Facebook or on the web.
Exactly.
And they should. It's a great interview.
I'm an investor and a board member there. Love the team, and that's a much better team than the predecessor team at Blue Lithium that was sold to Yahoo, but that team at Blue Lithium was a great team. So the teams have gotten better. In addition, the markets are much larger. I mean, when you have social media, bringing governments down, or if you look at
Facebook, Twitter, big companies.
Exactly. Or being at least the reason that some people are causing or saying it's responsible for one out of every 5 divorces. I mean, you're hitting foundations of our society, government, right. Marriage. I mean, people have figured out that these are big, huge, disruptive forces. Lastly, the faster. They're much faster to break even, they're much faster to profitability, and they don't take very much money at all to get there. So if you look at what's happened at these companies, the reason that they've raised money is to play to win as opposed to survive.
That said, Steve, when you look at some of these valuations on the secondary markets, Facebook, has hit upwards of $80 billion. Yesterday, Groupon is looking at a $25 billion valuation. Are those valuations justified?
Well, I do think in some cases they are justified. If you look at the public markets have justified. For example, OpenTable's been a public company for a couple of years. It's trading at 20 times revenue, and it's not growing at anywhere near as fast as something like a Groupon. So from that perspective, you could argue that Groupon is cheaper. I think in this case, the value of a company is based on scarcity value, which is what it's worth to somebody else. And it's also based on, just the supply-demand imbalance that occurs between many investors chasing too few number of shares out there. So you're going to get periods where, for example, the private market, as we are now, probably trades at a premium to the public market. But that doesn't mean that these companies are going out of business. That doesn't mean that there's this big bubble that's going to pop all of a sudden. So I just want to draw some sharp distinctions. And since there were a couple of quotes over the last couple of weeks, both Barry Diller and Mark Cuban, no disrespect, made some comments about valuations being unsupportable, or this being sort of a house of cards or a chain letter, and I just disagree.
I want to bring up that quote from Mark Cuban. Remember the old chain letter where you put up some money, then you got other people to put up some money, and you gave it to the people who were in the deal before you. Well, that's what's happening today. So saying it's not a bubble, it's a pyramid scheme, and you obviously think he's wrong.
Well, I mean, there are a lot of people that bought, Oracle in the 60s and 70s. There are a lot of people that bought companies when they're higher. I mean, that's what we predicate our markets on. Some people, trying to buy low and sell high, and some people wind up getting the timing wrong. But that doesn't mean these companies are going out of business or were, based on fallacious assumptions. I think we had a lot of that in the year 2000, and I don't think we have that right now. I think it's much more broadly investable. It's not a winner-takes-all market as we've seen, and I think people have now figured out in this specific case of social media that social media is going to be a lot bigger than search, and we know how big search was.
Steve, thanks for joining us. Really appreciate your thoughts on this business. I know you've been watching this a long time and are in the thick of it again, so it's good to see you and glad to have you on the show.
Thanks, Cory.
All right.